So chapter 10, remember the PowerPoint is chapter 11, so don't let that confuse you. Chapter 10 talks a little bit more about current liabilities. We're going to cover it briefly. We've done a lot of it already throughout the semester and the other chapters, but we will add a few more things in that we haven't talked about before. All right, so basically, if you recall, a liability is a debt that you owe to a creditor. So it's money that you owe to a creditor. They've occurred because of a past transaction. You have to pay something in the future, and they're unavoidable. Okay, you can't get away from it. All right, so if you remember, we have two types, two categories. We have current liabilities, which must be paid in 1 year, or the operating cycle, and it's whichever is longer. Generally, most places, the operating cycle is shorter than a year, so we tend to use a year as the rule of thumb. All right, long-term liabilities don't have to be paid within the year. Or the operating cycle. All right, some different terms that you might hear these as you go through your business career. Sometimes these are called operating liabilities. The current liabilities are sometimes called operating liabilities. All right, because they're part of your daily operations, okay, like accounts payable, trade payables, things of that nature. Long-term liabilities you might hear referred to as non-current liabilities. Sometimes I hear them called non-operating, but not as often as I hear the other ones called operating. All right. So, different types that you might have. Current liabilities can generally consist of account payable, which we've dealt with all along. We're going to look at sales tax payable. We've talked about unearned revenue before. All right, but it's generally any kind of payable. All right, salaries payable. We did that in chapter 3. Salaries payable, taxes payable, dividends payable. You know, we've had a bunch of them. Okay, we might even have notes payable if due in a short period of time. All right, notes payable can be long-term or short-term, long-term or current. Long-term liabilities tend to have notes payable that are due past a year. A mortgage payable, which is like your house payment, kind of. Bond payable, which is a way of borrowing a whole lot of money. And we don't do all these, we did those in another chapter. Okay, we're focusing just on current liabilities in this chapter. All right, so the first one up that they want to talk about is sales tax. Sales tax is something that we're very familiar to. We have it in the state of Texas. If you go to other states, not every state has a sales tax because they might have a state income tax instead, and you pay income taxes instead of sales taxes. It's very weird when you go buy something for $10 and it actually costs $10. Okay, so for the example, taxable sales for Smart Touch Learning were $10,000. The company collects 6% in sales tax. All right, so it has to be broken out because sales tax is a pass-through liability, which means that we collect and then remit to someone else. All right, it's never income to us. It's not something we get to keep. It's a pass-through liability. All right, so you're going to have cash in the sales revenue or even accounts receivable. It doesn't really matter. just like you would normally. But make sure that your sales revenue is only the sales amount of $10,000. Okay. All right. The sales tax goes into a separate account called sales tax payable. And it's a credit because it's a liability and it's increasing. All right. So we have a 6% sales tax. So it's going to be the 10,000 times the 6%. And then we're going to collect the total of $10,600. And then we'll have to remit this to the proper authorities, whoever they may be. All right, so here's when they're doing that. So when remitted to the proper authority, we're going to have a debit to sales tax payable and a credit to cash. All right, next one up, unearned revenue. We have done this one. We've had this one before. All right, remember that unearned revenue is money collected in advance of earning it. All right, so you have not yet provided the service or the product. So in this case, they received $900 in advance on May 21st for a month's work beginning on that date. So on May 21st, they actually collected the cash, so I have to have a journal entry. But I haven't earned anything yet, so it's going to go to unearned revenue. All right, May 31st, before I do my end of the month financial statements, I'm going to have earned some of it. So this was for 1 month of work. All right, and they tell us that they'd earned 1/3 of it. So when I earn 1/3 of it, I'm going to have a debit to unearned revenue and a credit to service revenue. And it's going to be 1/3 of it. All right, so the next one is a short-term note payable. Okay, these are due within a year. So this one happens to be 90 days. All right, so this particular one was they purchased inventory. I'm just going to copy this over. Oh, whoops. I don't want to do that. Okay, so on May 1st, Smart Touch Sewing purchased merchandise inventory with a 10% 90-day note payable for $8,000. The company uses the Perpetual inventory system. Okay, so a couple things here. If you remember, the $8,000 is the face value of the note. 10% is the interest rate, but it's stated on an annual basis. And then it's a 90-day note payable. Okay, and they bought inventory. So when they bought this, they're going to have, I guess I'll just keep working this way. On May 1st, they bought inventory. And they paid for it with a note payable. For $8,000. All right, it's 90 days. So at May 31st, let's see if that's what they want us to do. I'm assuming we're going to have to accrue interest. Oh, they didn't do it until the end. So no, we don't have to. Okay, so it's payable on July 30th. Now, notice here they're using a 360-day year. I want to make this big again. All right, so when I go to pay it, I'm going to have my note payable. It's going to come off at the face value of $8,000. I'm also going to have to pay interest expense. All right, my interest expense is the face value of the note times the interest rate times time, and it was 90 over 360 days. Okay, or my preference is to do the 8,000 times the 10%. And 90 days is like 3 months, so I could do 3 over 12. All right, I tend to do everything like this because it's easier than trying to count days. All right, so 8,000 times 10% times 3 divided by 12. All right, so I had to pay $200 in interest, so my cash is $8,200 out the door. All right, and remember, if the year end had fallen in the middle here, you would have to accrue interest. So if year end falls before the note is paid, you have to accrue interest expense and interest payable at year end. All right, and then finally, the portion of a long-term note that's due in the current year would be moved up to a current liability. Okay. So I'm going to stop with that one. And then, but go look for another couple videos. I will do a short little video on payroll, but it's not on your exam.